Guys, welcome. Today's show is going to be a lot of fun. We have 4 stocks we're going to look at right now, and we're going to run all 4 through the everything money process to find what we believe their true value to be and to determine the right price that we need to pay before buying. So then I'm going to teach you how to get paid to wait to buy stocks that you want at lower prices, and that's called cash secured puts. And this lets you generate extra income on the cash in your account, but again, to buy stocks that you love at lower prices. After that, I'm going to show you how to generate income on the stocks you currently own using covered calls. So first, you get paid while you wait to buy great businesses at better prices. And then second, when you have the stocks, you already own them, you can add income to that by selling covered calls on them. Now, overall, this can add a few percentage points a year to your annual returns, 2 to 4%. And that may not sound like much, but guys, you got to remember, we talk about this all the time, especially when we're doing retirement calculator over 20 or 30 years. Remember, when we talk about financial planners who charge you 1% and how much that eats away at your returns, imagine adding 2 to 4% a year. That can mean millions of extra dollars in retirement. That is the power of discipline. Or it could mean an earlier retirement. That is the power of compounding. And I'm going to show you how to do it in a simple way, not in a crazy, very risky way. And it's not a free lunch. There are caveats to the whole thing. But now, the first stock we're going to look at, this is one that we've been talking about for a very long time. I was fortunate enough to randomly, by luck, buy it at its lowest price in the last 10 years, I think, Meta. But guess what? I was the moron who sold it at $195 because it ran up too fast. But guess what? It was a great learning lesson for a lot of people. So let's pull up Meta. Oh, NASDAQ's down 1.1%. I freaking love it. Absolutely love it. Guys, I am here today to sit there and talk about these 4 stocks, $1.7 trillion market cap. So first off, as you guys know, your market cap is all your share times the price per share if you were able to buy all of them at once. But this enterprise value here of 1.78 trillion, that difference there is debt. So it's about $70 billion, which is a lot of money until you realize their free cash flow is $45 billion a year. And you're like, yeah, these guys can handle it. They pay this adorable little dividend of 0.3%, but because of this market cap being so high, it still eats up $5 billion of their free cash flow, which they can easily afford. 82% gross margin. Guys, Meta is the company with 3.6 to 3.7 billion active monthly users. They have WhatsApp, they have Instagram, they have Facebook. Just to let you guys know, I know Facebook's a little... People would talk about like how it's for older people now. I'll tell you what, there are Facebook groups though, and they're phenomenal. I'm involved in a few Facebook groups, and yeah, you got a lot of keyboard warriors, but it's a phenomenal group. Let's go to the 8 pillars here. So guys, I love seeing this. When I see great companies that have 6 check marks like this and the only X's are valuation, it says one of 2 things. It says to me like, okay, Paul, you might just need to be patient and wait for the right price, or hey, can they justify this? Because remember, a high PE in and of itself does not mean anything. You have no idea what, if the growth rate is going to be 30% a year, you have to pay a premium for the company. Okay, that's the big thing I want you guys to do. Now, guys, I want to introduce you guys to somebody. If you're in the community, you know him very well. I was on a trip the last 3 weeks, and this guy took over on this Plus channel and was doing a lot of videos, and people loved him. And at one point, I was worried my job was in jeopardy. My nephew, he's not my nephew, by the way. Sam, say hi, Sam.
What's up, guys? How's it going?
Just to let you guys know, Sam, obviously Sam knows. I met Sam through a live stream like this. That's the funny part. I was in a live stream. I don't remember what you said. You said something like, oh, I'm from the area. I said, oh, where'd you go to school? He said, Walsh Jesuit. I'm like, that's where I went to school. You're like, I know. And I'm like, I didn't know. So, and I talked to Sam a couple times in the live stream, just like in passing. So I said to him, I don't remember did you ask me to lunch? Did I ask you to lunch?
I asked you if I could come pick your brain.
Oh, that's what it was. And I met with them and I'm like, damn, this kid's like 24 and he's really freaking smart. So, I had you help us out, and now Sam's helping us out with videos just like Dalton has. So, yeah, it's pretty awesome. So let's look at these analyst estimates. So, Sam, we were just talking about Meta before the live stream, and you were saying things like, because we were joking. So there's a Bitcoin back in the last year and a half, I've been bookmarking a lot of Bitcoin tweets. And I'm picking on Bitcoin, but I'm picking on anybody who would say that on this day, the price of this will be X. It's ridiculous. But of course, the Bitcoin hypesters out there all just like circle jerk each other on what the right price is. So I put a tweet out. I retweeted somebody that I remember having because I bookmarked it. And he said in the tweet, Bitcoin will hit, what was the exact number? I don't even, like, what's the group chat?
Is that 80,000 or 70,000?
No. It'll never be below 80,000 ever again. And he wrote, bookmark this tweet. I said, I retweeted it today and said, luckily I did bookmark this. Guys, it's like the Winklevoss twins. You know, when they said on November 17th, it's the last time you'll ever be able to buy Bitcoin under 90,000. And it's literally gone up and below 90,000 like 10 times since then. Guys, making short-term, even long-term price predictions. You can sit there and say, hey, listen, I'm buying a great asset. I think it'll be higher in years to come. But to sit there and say, it'll be at this price, like Saylor, August of 24, he said, or whatever it was, he said that Bitcoin would hit 444,000 at some point in 2025. People writing about 200,000. Guys, they might be right, but if they are right, it's a pure guess. So that happened to do with what you were saying today about Meta being at $88 a share. Why don't you tell everybody what you're talking about?
Yeah, so we were talking about these type of price predictions in general, because I said to Paul, as Meta fell from 340 to 88, when I was buying sub 100, I absolutely believed this thing would be up 2, 3, 4x over years to come. But it's just if you have an understanding of markets and how they operate, you don't make those type of predictions because it's unnecessary. Why would you play a game that it's so difficult to win and your success doesn't rely on
100%
getting those price predictions correct?
Yeah, you just have to buy a good company. And by the way, I've made these mistakes, shorting, certain companies and using valuation as a shorting. Just like, no, that doesn't work. Now, I was never trying to predict exact prices. I was never sitting there saying like, this thing by the end of the year will be, it's like, listen, I have no idea. And you guys will see me say that in videos. Guys, I don't know where the stock is going to be in 2, 3, 5, or even 10 years. All I know is that if I buy a good company at a good price, eventually the market will realize its value. That's it. And I know you might sit there and say, well, that's not very fun. And too bad. That's what makes investing so difficult. It's because everybody wants this certainty of if this company's up a lot, it's going to mean if this company's revenue goes up, it means that the stock is going to skyrocket. Well, guys, look at Cisco. The previous all-time high before this year was $82 in August of 2000. And they had record revenue basically every single year since 2000. And it took until this last year in August before it hit another all-time high. The stock went from 82 down to the teens and then slowly but surely climbed itself back up. All right. So guys, here is Meta's stock. Here are the analyst estimates on Meta. I mean, pretty decent growth. Nothing like, earnings per share, 11.5, 14.5, 1%, 9%. Now guys, I want you guys to remember, this is an average of all these analysts. And if you look at the years, the analysts, they go down and down and down. So that's how you get like major random, numbers here where it's only like a 1% increase. Analysts have a tough job. It's not, I wouldn't want to be an analyst because they're basically trying to be told to predict where prices are going to be or things are. It's a nice guy to sit there and say, what do analysts, I always tell people, analysts are wrong all the time. I still remember Larry Ellison after the 2000 dot-com burst. Some analyst was like telling him he wasn't very smart. He's like, I'm not smart. You guys are the idiots who are giving pets.com buy ratings and saying like, don't tell me I'm not smart. Like, and it's true. It's just like these guys analysts have it hard. For revenue growth, look at this revenue growth. So here's what confuses me. The gross margin on Meta is 82%. What this means, guys, is every dollar they bring in, 82 cents of that basically goes to the bottom line before taxes and overhead. If you're able to grow your revenue 17, 15, 15, and 12%, you got to be able to grow. That means to me, with that gross margin, profit should be up like 20% a year. But it's not. So I wonder, like, are they sitting there and just expecting much more expenses along the way?
I think that's what they're guiding.
They have to be. Yeah. But that's not CapEx, guys. That's not capital That's not capital expenditures. That's just operating expenses.
Yep. I have their most recent earnings pulled up.
Pull it up.
I covered it. I think we did Meta 2 weeks ago.
Probably. I was on my trip.
They grew revenue 24% year over year in the most recent quarter.
That's absurd.
Expenses grew 40%.
See, there you go. But to have this kind of expense growth every single year,
yeah.
Let's actually go look at that. Let's go see what their expenses were by year. I actually would be interested in seeing that. So SG&A expense. Now let's do SG&A expense. So the funny part is, it's not that.
No, it's really not. I mean, it's up a lot from 2018, 2017 levels, but anything post-COVID's been pretty.
I mean, they had one fluke year of $27 billion. Other than that, it's been.
Now R&D is up from $18 billion.
Oh,
to
F, you're right.
billion.
Thank you. So, guys, thank you very much. R&D, 18.5, 24.5, 35, 38, 44, 52. You know, but early 2000s, R&D was a big, you know, like it was very much people were arguing about R&D. Is it a capital expense? Is it an expense? All these things. And because small business owners like me, you try to lower your tax bill. But publicly traded companies, they don't want to lower their tax bill. They want to show more profit. So they're going to sit there and try to make profit look a lot better than they think it is. Okay, so now, guys, this is the big thing. And you've watched our videos 1,000 times, hopefully. I always start every company I look at with my stock analyzer tool. And the reason being, I can't explain this any clearer. Don't fall in love with the story. Don't fall in love with the numbers. Sit there and say, is this worth my time? Fall in love with your time. There are 10,000 stocks, there's actually more than that, to choose from. Go spend your time on the ones that make sense. So when I start with Stock Analyzer tool, I put in my reasonable assumptions, and if the number is close or if it's all green, then I spend more time. If it's not, why waste more time? Meta's at 650 right now. Hypothetically, if we did the Stock Analyzer and it said it's worth $50, why would you spend a second more on it? So why would you spend 1 second more? So let's pull up the last time I did it. Dun, 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 dun. Love Sam. We all love Sam. Hey, guys, you can talk. Okay, so beat me up here, Sam. I did revenue growth for the next 10 years of 6, 9, and 12%, which is way lower than the analysts expect.
Yeah. So they just guided for 30% in 2026, which is insanity. So the issue is at the scale that they have, you just can't perpetuate that out over 10 years and call that a reasonable assumption. Question is, what becomes reasonable with how they're growing right now?
Yeah.
Could they do low teens on the high end? Potentially. Could they do a 13 to 14% if you're going aggressive?
So
I don't disagree with your assumptions, though.
I think they're low, but at the same time, guys, we're not factoring in. I'm keeping the profit margin at high levels. Yeah, so I look at the saying, okay, if they're going to increase if they're going to grow at 12, 13% a year, but their expenses are going to grow at 20% a year, I can't be putting in this profit margin at high levels. Okay. Now, again, for your back of the napkin numbers, maybe you just walk in here and go, okay, lower revenue growth, but I will keep the profit margin the same. Or you do higher revenue growth and decrease the profit margin as they talk about keeping these expenses higher. So I put in 28, 32, and 36 across the board. I think that's the free cash flow number is not going to hit. I mean, this is going to be a big miss.
No, because they're going to continue to spend massively on CapEx. I think you've seen it at this point. It doesn't matter if it's AI or the metaverse or whatever.
100%.
They're going to spend on the CapEx.
So focusing on profit margin here, I mean, Sam, you tell me, do you like 28, 32, and 36, or would you go lower? Would you go higher?
So it's interesting because you have to talk about what the future would look like and how the expense could be a negative or a positive. So that's why I think the range is good. I think in general, if you look at the profit margin, you're at 30 to 31% across the board on a 10, 5, and 1 year. So I could see the argument where someone in the community, I think, recently said to me, like, they literally just go 30, 31, and 32.
Oh, wow, really?
Just because
that tight of a range.
So consistent, yeah. But that being said, with the amount of expense and CapEx going on right now, I think you'll either probably see a headwind to it or you're going to see a tailwind where it either improves or declines to some capacity.
I'm a little stuck on this one. I'm going to keep it the same, but I actually want to go lower, but I'm going to keep it the same because of my lower revenue growth.
Yep.
Now, what PE would you assign 10 years from now to this company?
It's a good question. I mean, there's so many different factors in it, right?
Of course.
You got the long-term average of the market. You have where interest rates are right now. If President Trump keeps driving them down by force of nature, I mean, interest rates are gravity on equity. I mean,
yeah, that's true.
So if we're in a 2% interest rate environment where you're getting 2% on bonds, all of a sudden paying 25 to 30 times earnings for a really good business, that means you're getting a 3 to 4% yield on your money, which is, if it's going to be growing, say, 10 to 15% per year, that means that 4% yield in 5 years will be 8%.
Yeah, so I keep it for me, and I'm not saying my method is the right method. I don't even look at it as that. I don't care where interest rates are. Because to me, Sam, here's the issue. If somebody told me 10 years from now rates are going to be 15%, what do you want to make on a stock investment? People would say like 18 or 20. I look at it going, if rates are 15%, the market's going to fall anyhow. I'll find my opportunities.
Yeah, absolutely.
I'm just going to start, like I always say in videos, I just sit there and say, listen, 15 to 16 is the market average. Do I go higher or lower from here? That's the way I keep it as simple as possible. But guys, remember, I keep things simple, and that makes me probably overlook some things and miss some things, and not find real value in as many things as I can. But for me, I'm looking at companies like Meta. I'm not trying to buy some small company. So how do you feel about this 2023 and 26, Sam?
I think it's a reasonable assumption. I mean, I think 20 on the low end makes sense. I mean, this is just, I find it hard to believe that a company could come along and actually significantly disrupt Meta.
It would take, it's the whole question we ask if I gave you $1 trillion today and said disrupt Meta, I think that would still be very difficult.
Very difficult. And that's the question that you have to ask, because you have to pay a premium for a business.
100%,
like that,
you have to.
You don't have to worry at night. If you buy Meta at a reasonable price, you don't have to think about it.
Correct.
Probably 5 to 10 years from now, you're just going to look up and you can be doing well. Now, you're not going to make a price prediction that it's never going to be below $300 in 5 years. But.
So I'm going to keep this 2023 and 26. And by the way, guys, I've said this in many videos. If you said to me, Paul, you're an idiot, it's 18, 20, and 22, fine. If you said, Paul, you don't get Meta, it's 22, 25, and 28, fine. Like, I really don't know the right number. And that's why it's all so important that you use this tool when you start and when you end your research, because I look at it going, it's a great way of just saying, let's put some reasonable assumptions here. And then I put my 9% desired return. I never put my margin of safety in on this one. It's only to sit there and say, what do I think this company is worth right now? I hit the analyze button. Stock's currently at 650. God damn, look at this. 475, 1200, 750 in the middle. I'm the genius who bought it at 88 by luck, and then I'm the brilliant guy who sold it at 195. Oh. But I believe if there's a bear market, a bad one, great companies will all fall. Meta will be one of them because it makes up 1.7 trillion market cap. It cannot not fall, right? So, guys, what do you think? I don't know. I think, let me see if there's any comment. Oh, yeah, Adobe. We'll be going over Adobe, don't you worry, at some point. Wait, are we doing Adobe today? Okay, we are doing Adobe. Yeah, this is the Mealy statue. Oh, he's talking about the Monish Pabrai down there behind Sam. That is
from when you guys interviewed him?
Yeah, from when we interviewed him. Yeah, this is the way I look at it. Okay. Where's the, still 1.11%. NASDAQ's down 1.11% now. Me like you. Oh, Bitcoin's up. I've noticed that, no, it's not. Disregard. It just took some updating. That makes me happy. NASDAQ's down 1.43%. Bitcoin's down 0.82. But I will say, I've seen Bitcoin not be as attached. Like, it's been a little different than NASDAQ lately, but that was funny. I was like, it's still the same. PayPal. Now, guys, PayPal, look at this thing. It's down to $39. I had a friend of mine troll me the other day and say, hey, Paul, did you see PayPal? I'm like, yeah. He's like, no, I'm not worried. And by the way, I'm not saying I am right. What I'm saying is if I have 30 companies that have this we'll go over the stock analyzer tool. That's what we're trying to focus on here, guys. We're trying to look at, I want you guys to think about not making a bet on one company. And I know the greatest investors say that diversification is a bad thing. I get that. But I also like the idea of saying, I'm going to be diversify into undervalued businesses, because I look at it and go, if I have 30, 40 companies that are all undervalued, if I keep buying them, it's probably unlikely, especially as large cap companies, that I'm wrong on all of them. It's going to be very difficult for that to be the case. Am I taking the lazy way out? I don't think so. I'm taking the way that makes sense to me based on my situation. Sam's situation is different. Dalton's situation is different. Dalton sits there and he buys these obscure companies because, the shipping, the ship costs, $800 million to replace, and he's buying it for $100 million. And he's excited about it. And I'm like, cool, Dalton, go ahead. And I give Dalton a little bit of my money to buy stuff, and he buys it. And I'm like, hey, I want to buy PayPal. I'm not going to make the upside on PayPal in my portfolio probably that Dalton would. I mean, Dalton, I think one year was up like 98% on the money. And I'm like, yeah, that would never happen with me. And I'm okay with that because I'm honest about where I am in my life. All right, so PayPal. This is what I love about PayPal. Oh, I love this chart. $310 a share was the all-time high. Since then, and guys, I repeat this till I'm blue in the face. That was the end of 2021. Let's look at the financials. $25 billion. If you're in the middle of 2021, you look at the previous year. They did $21.5 billion of revenue. Now they're doing 33. It's a 50% increase. Now the profit's not as high. It's 4.2 versus 4.9. But the point is, the profit is still greater. The profit is higher, but it's not as big a jump. And the stock is down almost 90% from its all-time high. That alone does not make it a value. I want you guys to remember that. Bitcoin selling for $700 per coin is still overvalued to me. I'm not saying I'm right, but it's still overvalued to me. I don't care if it falls 99% from here. I still consider it overvalued. The idea of saying something's overvalued or undervalued just based on price movement in and of itself is ridiculous. However, it's a nice place to look and say, wait, the stock is down from 310 to 39. Revenue's up, profits up. Let me pay attention. That's it. That's all I'm asking you to do. That's all I'm asking you to do. I'm not asking you to sit there and say it's a value because look at Workhorse. Look at Tattooed Chef. Those companies were down, well, they ended up going to zero, but at one point they were down 98%, still overvalued, right? This is very, very important. Now, what's interesting about PayPal is I like PayPal. Yesterday we were in our group chat and everybody was, and even Tim asked me, he goes, Paul, what stock are you the most excited about in your portfolio? I didn't say PayPal, and everybody else was like, yeah, we like PayPal. I was like, oh, that's interesting. I did not say PayPal. I'll tell you guys which stock I said later, but I didn't say PayPal. And PayPal is, by the way, not because I think PayPal is not a great, the juice is worth the squeeze here. I think it's worth the squeeze here, but Sam, did you agree that PayPal was more exciting than the other stock I picked? Do you remember what it was?
Yeah, I do remember. And no, I don't think it was more exciting. I think that
in terms of the value play,
I think it depends on how PayPal's business performs, obviously.
Well, of course, it always depends on that.
Paying 6 times cash flow for a business, the upside's significant. I think the other business is still performing better. I think the other
I agree with you.
I think the other business's moat is still intact more, and the growth is still there.
I agree with you.
That it looks like a better proposition.
I agree with you completely. That's what I was saying, and we'll get to that business. But guys, look at this: 6.8 times free cash flow. When it was selling for 310. What was the cash flow back then? Let's go see that. Let's go see the cash flow statement. It was, let's go to quarters, quarterly. And that was mid 2020. No, when was it at 310? Mid 2021. There you go, mid 2021. So what I'm gonna do is I'm gonna go quarterly, mid 2021. Basically it was 1 billion, 2.6 and 1.5 is 4.1 plus 1.0 is 5.2 billion in free cash flow. Last year they did 5.6. Okay, so basically it's the same free cash flow, but the price is now 90% lower. The cash flow is actually up, but the whole point is it's 6.8 times now, which means it was like 50 times free cash flow at its peak. I want you guys to remember, this is what I talk about. Boy, I'm really picking on Bitcoin, right? But it's about any investment. And by the way, I was thinking about the other day. I was driving home the other day from the airport. And I thought to myself, we confuse investing and speculation. You could speculate into investments, right? I can say an asset is an investment and an asset speculation. I think art is speculation. I think gold is speculation. I think commodities are speculation. I think Bitcoin speculation. But you can buy PayPal, which I think the asset is an investment, but you can speculate by buying a company. Because if you don't have a process of thinking, that's the act of speculating. That's what and so when if somebody told me the story behind PayPal and it never factored in the price, I'd be like, you're speculating. The price versus value is the crux to all investing. Okay? This is why we use these things, to sit there and understand it. Now, with PayPal, I'm going to get into the cash secured puts on it because it's selling for such a great price. But look at this, 8 pillars, 8-pillar thriller. Analyst estimates. Again, analysts aren't geniuses, but they have it growing from $6 a share to $9 a share. Didn't you say that PayPal was buying back shares? What was their announcement?
Massive amounts.
Yeah.
So they expect to produce $6 billion in free cash flow as of 2026. They expect to repurchase $6 billion worth in shares. If you look at the market cap, you're looking at a $37 billion market cap.
That's what I was saying.
That's nearly 20%. I mean, you're looking at 15 to 20% of the market cap being
Every year.
taken away.
This year. So hypothetically, let's say PayPal stayed at $40 a share for 5 years. They could literally buy back every share in the company with the cash flow, as long as they keep the cash flow the same. This is the power of buying back cheap shares. So let's say that you stick with PayPal. And let's say it stays at $40 for the next 5 years and they buy back half the shares. They buy back half the shares. They go from, let's go see how many shares they have outstanding. 950 million. Let's call it 500 million shares to be safe. Now they're dividing that 5.6 billion by 500 million shares. They're now generating $10 per share in free cash flow. They're not selling for 6 anymore. They're selling for 4 times free cash flow. Eventually the market will say, okay, it should be much higher than that. And eventually the market will sit there and say, we're going to give it a higher value. If you don't think that's true, I think this is playing out with Southwest right now. The market's finally saying, oh, the margins are going to be better than we thought. You know what I mean? Eventually the market cares. Now, even in a declining business, if PayPal is declining, which the revenue is up, by the way.
4% year over year.
Nothing to write home about. But remember, if something is cheap enough, you don't need growth. Hell, if something's cheap enough, you can have declining revenues and still be fine. Look at British Tobacco.
That's what I was going to bring up.
Is that what you're going to bring up?
Yep.
British Tobacco is a company that I have. And trust me when I say, I was like, that's a declining business, but fudge, that thing is cheap as F.
4 times cash flow. I mean, do the math. If you pay 4 times cash flow, it's a 25% yield on your money. If you get a 25% yield on your money, even if it declines 1 to 2% a year, I mean, if they would have bought back,
that's the thing. European companies don't buy back. Why do they not buy back? They're idiots.
If they bought back, it would have been insane.
They had a 10% dividend yield when I bought it at 30. And I'm like, stop the dividend. Buy back your shares. I digress. The bottom line is I look at PayPal and they're buying back cheap shares. I freaking love it. I freaking love it. Okay, so let's see. Analyst estimates, we talked about their 595 is 923. And revenue growth, 6 or 7% a year is what they expect. Nothing to write home about. Nothing to write home about. Every time I get on a live stream, that thing. Every time I do a video, that thing. Other than that, it doesn't ring. Okay, so here are my assumptions on PayPal. Like I said, analysts think 6 or 7% growth of the year. I did 3, 5, and 7. Thoughts?
I think that on the low end, you could make the case to go lower, but they just did 4%. I mean, you could really, just see the valuation perspective, go lower.
246.
Just to get an idea.
246. Profit margin. I'm ignoring profit margin because it's a free cash. It's a cash flow play here.
It's a cash flow generative business.
I did 16, 19, and 22. The reason I did 16 was last year. The reason I did 19 was the last 10-year average. And the reason I did 22 is, okay, if their average is 19 over the last 10 years, and they did 17 and a half in the last 5, it means the previous 5, they probably did 21 or 22, so they're capable of it. That was my logic.
On top of the fact that we've seen the previous CEO push for growth, which means they may have given up some margin in that scenario. If we see the new CEO come in from HPQ, he may look to cut expenses to some capacity, which will then boost margin. If they're not shooting for 10% growth anymore, and they're accepting being a 3 to 4 or 5% growth business, they should be looking for efficiencies, not
1,000%, and buy back those effing shares.
Yep, exactly.
Next, PE. Now, guys, I'm going to sit there and decrease the PE. Even though their ROIC is getting better, if it's not going to be a great, sexy business, I'm going to go 13, 15, and 17. What do you think, Sam?
Yeah, I think that makes sense. I mean, I'd say if you're looking at a 0 growth to declining business, I always tell people when I talk with them on community live streams,
8.
The simplest question I can ask is, if you want to get a 10% return, think about the actual business. If you want to get a 10% return on your money, what multiple do you have to pay if they're never going to grow again? 10 times earnings. And you get 10% year in and year out. So if you have a 0 growth business and you want 10% returns,
10 PE. Now, what's that equation that it's an intelligent investor? They talk about like 8.5.
It's like 8.48 or 8.5 times for a no growth business.
Yes. So I don't, but they might be more conservative, but I like your
That was
logic,
also
Sam.
conservative, and it was in again, interest rates are all a perspective thing. Some people factor them in, some people don't. Much higher interest rate environment back then than today. So you could
And
say,
that equation did include interest rates. You are correct.
So you could say that in today's environment, maybe it's 10 to 11, 12. I mean,
yes,
you're getting
right.
8 to 9% return on your money.
Yep, you're right.
Double
you're right.
the risk-free rate or more.
You're right. So I did 13, 15, 17, and 9% return. Scroll down. The stock's currently at 39. Guys, we lowered our assumptions, and look at this. 60 to 70 on the low side, 113 to 150 on the high side, 80 to 110 in the middle. Now, the current price return based on a discounted cash flow model, low side is 20% based on today's price, high side is 33. Again, I'm not saying this is going to happen. What I'm saying though is if I had 30 companies that were multi-billion-dollar companies that I could buy with these assumptions, I would light my cigar and walk off into the sunset. I mean, I'd be like, okay, do a 20-year analysis and do the exact same assumptions. The IRR at today's prices is 17, 22, and 28.
If you do that over 20 years, can't beat it.
I would literally piss through all the money I have that comes in my door now, and I wouldn't even add to my portfolio. I'd be like, I don't need to add to my portfolio. If I had 30 companies that had these kind of metrics, again, I don't know if any individual company is going to do better than that. But what I do know is that if I'm able to buy 30 or 40 great companies like that, I'm going to do pretty well. Now, one of the stocks I mentioned earlier, Southwest. Go ahead, Tim. Go ahead, Sam.
Let's get a quick question.
Yep, let's go.
From the audience. And maybe you can even talk about the pay package. But he said, what do you think, and this is from Dario, what do you think of the new CEO? Was it HPQ, bought back tons of shares under him?
They did. HPQ is still struggling. But I like what Sam say yesterday what you said in our group chat about the compensation structure.
Yeah, so I think Dalton actually sent the initial.
Oh, sorry, Dalton.
Initial piece of it. Dalton's in the chat, by the way. Dalton sent the initial picture, but what I said is the previous CEO, and Paul and I have actually talked multiple times about the fact that show me your incentives, and I'll show you the results. It's a famous Charlie Munger thing. He was huge about it. It's all about behavioral psychology.
Yep.
The prior CEO, Alex Chris, received like $42 million instantly when he started in year one with PayPal, and then was expected to receive around $7 million a year in base salary, not a ton of stock-based incentives. Now, Paul said obviously you'd rather have it tied to the actual business, the cash flow and the revenue, and how they perform in terms of that. But the new CEO coming over from HPQ is being paid almost entirely based on how the stock performs. So his entire pay package is going to be tied for how he does for shareholders, which is far more favorable as an owner of the business.
Far more favorable. Now, as Sam said, the reason I don't like that is we have no idea what the stock's going to do. What I'd rather tie it to is, hey, if you increase revenue by this percent per year, if you increase cash flow by this percent per year, if you increase net income, that's all a CEO can control. He can't control where the market is going to determine the prices on any given day. Has no control over that. I believe in that. Like, we sit here and look at it we have a real estate business. We have 1,000 apartments. I never incentivize my staff based on what the value of the apartments are going to be. What I incentivize them on is revenue, expenses, and therefore NOI, net operating income. Because at the end of the day, whether somebody's going to pay me 10 times my profit, 15 times my profit, or 8 has nothing to do with what my staff does. What matters is they can only affect these things. So that's why I sat there and said that in the group chat. I was like, oh, I don't even like the fact that, because what if all of a sudden, let me ask you this question. Let's say the revenue falls 20% and profit falls 20%, but the stock happens to triple. What did he do? He didn't do that.
Yeah, correct.
The market just said, oh, wait a second, we should buy PayPal.
PayPal's not as bad as we thought. Market's up 3x, he wins. Like, I get it, shareholders win too, but not the best way to tie incentives.
You know what it's like? I look at Steve Ballmer. Everybody hates Steve Ballmer because he took over Microsoft in like 2001 or 2. The stock dropped 80% until 2012. And they're like, oh, he was a terrible CEO. I'm like, no, go look at the profit and revenue. He did a really great job. Yep. And it was perfect timing that he stepped down. New guy takes over literally as Microsoft's about ready to surge. It's like, but everybody blames Steve Ballmer. Like, no, this is not a blame of Steve Ballmer. Steve Ballmer did a great job. He just had the stock market happen to crash.
If you come in at 300 times earnings.
Yeah, what can you do?
What can you do? Like,
you're not going to win on that one.
We have one more question, actually.
Let's see it.
Tim pointed out another one to me. So this one's coming from S. Bennett. And this is where I actually have a note because someone brought up Monish Pabrai. And in Don to Investor, he talks about heads I win, tails I don't lose.
Yeah.
So bringing that back to PayPal, somebody brought up the question of what if a company like Amazon or Apple say, we want to own Venmo, we want to own PayPal. So that's the question is, what would you think of something like that? What I caveat with is, that's where you get to the heads I win, tails I don't lose. Because what would a private multi-trillion-dollar business be willing to pay for $6 billion in free cash flow that's growing?
Correct.
Higher than $30, $40 per share.
That is the point. And buyouts, I've said it about Intel. Remember when I was saying that about Intel? Yep. When Intel started to get to $20 a share, I'm like, we're at the point now where somebody's going to buy them. And sure enough, got to 17, and all of a sudden there were rumblings. Does NVIDIA buy Intel? Does Apple buy Intel? And like, at some point, people in the market would go, we're missing. I remember Mo, I actually liked the idea. Mo said it about Peloton. When Peloton was crashing, he said, why isn't a company like Amazon with all these users, all these things, go buy Peloton? Yeah. I was like, yeah, makes sense. And now is Peloton back up? But the bottom line is, in these buyouts, when the companies see these stock prices so low, you better believe if somebody wanted to buy PayPal tomorrow, it ain't selling for $39 a share.
You're looking at $65, $70 a share.
100%. Minimum.
Yep.
They're going to go in and say, yeah, we're going to pay a big number. Because part of the reason is they don't want to get in a bidding war with somebody else. Because if they only offer $40 a share, all of a sudden, somebody's going to step in and go, wait a second.
Warner Brothers.
Oh, yeah. Look at Warner Brothers.
Warner Brothers. This thing's traded sub 10 for 2.5 years. Nobody wanted it. And all of a sudden, company comes in and makes a $20 offer. Boom, 24, 28, 30. All of a sudden, you've got a 3X.
And so the idea in investing is, if you find a business that's able to grow, even if it's only a few percentage points a year, and even if the stock continues falling, one of two things is going to happen. If they buy back shares, they're going to buy back every share imaginable. And two, if somebody else finally sees the value and just to start buying it, there's going to be a lot more value generated there. I remember when Dell went private, they were selling for like 9 times earnings. And everybody hated Dell at that point, which was the darling stock of the 1990s. All of a sudden, selling for 9 times earnings, they wanted to go private at like 11, and then the lawsuit started. Because people are like, this is not the value of the business. It's like, oh, now suddenly people realize there's value to a business.
Yep.
I feel like I have a winning lottery ticket numbers for a future lottery with PayPal at its current price and the bar prices I've DC'd on the way down. Yeah, that's why I'm down on my PayPal. Not worried about it.
Me too.
Not worried about it. And listen, like I said, the way I am built, I like having the idea of having 30, 40, 50 companies that I own that are undervalued. And then over time, dollar cost averaging them as the values stay lower. I already talked to Dalton about this, like someday. I'm not recommending people go. I remember it was funny. I was talking to a buddy of mine last night. And he told me he bought Alibaba at 200. And this is a friend of mine. We're partners in a business. I go, you bought Alibaba at 200? He goes, yeah. I go, I wasn't buying it at 200. He goes, I know. I go, why'd you buy it? He's like, because I heard you talk about it was getting interesting and I put all my money into it. I was like, now he's
exactly what you told him to do.
No, but no, he didn't say that.
I know, I'm just kidding.
But then when it fell again, when it went below 100, and we were talking about it in in our Wednesday night calls, he goes, I bought even more. So his basis is like 120. So I was like, dude, why'd you do that? He goes, I know. He's like, that was so stupid. I'm like, you put all your cash into Alibaba. He said, yes, I did. I go, wasn't that stressful? He said, yes, it was. I was like for me, I don't like that.
You forgo the entire point of investing. Morgan Housel actually listened to one of the YouTube podcasters did like a 2-hour interview with him.
Yeah.
Just the other day. And like, you forgo the point of investing. It's not just some game. Investing is to build the wealth, to give you the freedom, and to sleep well at night.
So do you buy into the adage? Because Sam, you're a smart guy. You're well-versed in investing. Do you buy into the whole idea of you should only own 7 or 8 companies that you know very well?
I think that there are certain businesses that if you get to buy at the right price, like if you told me that I got to buy Microsoft, Amazon, Meta, and Google at 8 times earnings today,
yeah,
I'd feel comfortable owning 4 businesses. I don't know that I would, but I'd feel comfortable with it. That being said, I challenge you to go on and look at all the 13 Fs from the past quarter and find more than 1 or 2 investors who own less than 5 companies. If you go on there, it's going to be a list of 10, 15, up to 200. So they say diversification is a hedge on ignorance and you don't need to diversify, but then you go find them owning 10 to 20 plus businesses.
I'll tell you what, guys, I own real estate, I own stocks, I own businesses. And at the end of the day, I sleep very well at night. You know, I was famously shorted NVIDIA and lost a lot of money on that one. Guess what? My net worth still went up that year. I always tell, I'm like, my net worth, I don't remember the last time my net worth went down. That's not a bragging point. That's just to say, that's why I diversify, because I don't want to have any one thing at any given time that causes me to lose sleep at night. You know what I mean? That's my mentality. Now, Buffett and Munger, go ahead, Justin. Oh, there's a question here. Remember, guys, never buy a stock that I own. Never buy a stock that anybody here. By the way, I don't think I've ever forgotten to say that. And I just sat there and forgot to say that there. But This is very important. Go
I'm
ahead.
just so good looking that you were distracted.
I
and
was.
forgot about it. That's on me, guys.
You know, I will say something. I want to say that my good friend here, Sam, after he came on our videos, he's gotten a little cocky. So I think we need to like, what was that? Humble him just a little bit. I'm just kidding. Sam's not cocky
Yeah,
at
if
all.
you guys want to let me know, maybe I need a new haircut. It doesn't look so good. I didn't shave right this week. Feel free to drop that in the comments.
You know what I love about Next Fata? Do a FANG analysis. When was the last time we talked about FANG?
I forgot FANG even existed. That was like
Exactly.
when I started investing like 5 years ago. It was like FANG.
So when I did this when I did this Mag 7.
MAGA 7.
The MAGA 7. When I did this Mag 7, my own version of the Mag 7, and I sat there and said, I'm going to do it for years to come. The problem with that video is 2 or 3 years from now, people will be like, who cares about the Mag 7, right? That's the issue.
Yep.
But it'll be about reminding people that's the point. The Mag
remembers
7
that.
was the thing,
Yeah.
just like FANG was. Matthew Kelly, question. What would you do if you have a company that's growing its revenue but it's fallen below $1 a share? I believe in them. I'm afraid they might get delisted. How would you navigate it? Sam, here's my opinion. What does it matter if it gets delisted? I don't say that to say you shouldn't care. But a lot of times, a company getting delisted might be a good thing. I'm not saying that's the right case or not. I don't think your money goes away if it gets delisted. I don't know what happens there, but you need to call your brokerage and ask them what happens if it gets delisted. Does it go over the counter? I don't know what happens there. At the end of the day, you have an ownership stake in a business. And that can't just be taken away. Like, look at, remember Baba, when everybody's worried, like, oh, you're going to get your shares taken away. And I called Merrill Lynch. I go,
You own
guys,
on the
what
Hong Kong
happens?
Exchange.
What was that?
You own on the Hong Kong exchange.
That's what I said. They said, Paul, the only thing that happens goes on the Hong Kong exchange. If you want to sell it, it just might take a few weeks for the money to get back to you here in the States. I go, oh, that's it? He goes, yeah. I'm like, I don't care then. That's, to me, that was a prime example of fear not being grounded in reality. I made one phone call and said to my Merrill guys, what happens? They go, we're going to go verify for you, but this is what we, and they call, they verify. You go, Paul, all that happens, it goes to the Hong Kong exchange, you own the shares there. If you want to sell it, you sell it there, and then we wire the money back to you here. It goes, it might take a few weeks. I'm like, don't care.
Yep. I always tell people, the market and general investors don't differentiate between uncertainty and risk. But Bryce says it all the time. Like,
Yeah.
they view them as the exact same thing. When uncertainty, like PayPal, ton of uncertainty right now. Like, will PayPal decline 1% a year? Will it grow 3% a year, 7% a year? That's the uncertainty. People view that as a risk. It's not a risk. They just don't know what's going to happen. So it's priced right now that -1, 2, 7% should do well under any of those circumstances.
And that's the point. The assumptions being made about Meta back when it was $88 a share. By the way, go watch our videos. We never hide any of this stuff. Watch the videos, and I sat there and said, everybody's worried about this metaverse losing $10 billion a year. So the worst case is it still loses $10 billion a year, and the company's still worth $300 a share. Or the best case is they go, oh, F, we screwed up. No, that's not the best case. The middle case is this isn't working, we'll stop it. All of a sudden, $10 billion more comes in their coffers every year, which makes the value of the shares from 300 to like 400 or 500. Or the third best case is it works. Like every option was heads I win, tails I don't lose. It's like,
Correct.
okay, so you're welcome, Matthew.
You're getting a lot of love, by the way, right now.
Why? What's that?
Nate said, Paul looks like he's been doing Sam's workout splits.
Do I look buff?
Apparently, I mean, we have a community chat section on
Please tell me you're
the
joking.
gym and exercise. You know, so we
do
actually
have
do
that.
a couple of community members. We talking there about like what our workout splits are. So you must be.
I'm doing something. Superconductor. PayPal really feels like Meta right now. I think Meta was, to me, a more obvious buy than PayPal because Meta still had the growth. Meta still had the revenue growth. I remember, go watch our videos. I remember saying to people, guys, Meta makes $40 in revenue per user in the US. Internationally, they're at $3 or $4. Like the gap between the revenue growth potential was insane back then and still is. So that's why with PayPal being different, to me, the numbers are, you're correct. Like the potential is there in terms of the IRR, but Meta to me, I remember being like, what am I missing on Meta? I do think there's possibility of PayPal. There's a lot of competition in the fintech space. That is my biggest concern about PayPal. But I will say this. I don't think Apple Pay is a competitor to PayPal. It is in some elements, but I look at PayPal as PayPal is very big on the consumer. if I buy something from somebody I don't feel comfortable with, I use PayPal because I know they're going to have my back. Apple Pay is just a facilitator of ding, ding, I paid. That's it. You know what I mean? And I don't look at that as the same kind of thing. He prefers Coke Zero, 1,000,000%. By the way, I was at a gas station the other day. So next Fatah just said, let's look at hymns. I was at a gas station the other day pumping gas, and I interrupted the guy behind the register because he was looking at hymn stock. And I was like, I don't know if this is a sign of the times. Let's look at stock number 3, Southwest Airlines. Guys, talked about this company for 1 billion years. My thesis is one very simple thesis. Profit margin. Before COVID, it was consistently 10 to 15%. I'm being conservative when I say 10. Now it's at 1.5%. This is purely a profit margin play. That's it. Yes, it's an airline. That's my biggest concern about it. It's a good business, and it's a good business in a bad industry. Warren Buffett will say the bad industry will win. Southwest, I'm hoping, is the exception, but look at the analyst estimates here.
All right. Now here's something really interesting for you. So like circle that $2.70. The company guided for 2026 to be no lower than $4.
Did you hear that, guys? So analysts are able to update, and they're not, and it's at $4. So, guys, I just look at this going, this is a pure margin play. They went through a lot of shit, even before COVID. I remember when I bought it right after COVID, or during COVID. I remember being their 10K. And the previous year, they made like $2.2 billion, but that was after they lost $870 million in the whole 737 MAX issue. And I was like, they should have made like $3 billion that year.
That 650, I've done the math before, I think on our live streams in the community, that 650 is like 3.3 billion in free cash flow 4 years from now. They did that in like 2018 or 2017.
So you look at this going, how does Bennett know that?
I was wondering the same thing.
Okay, Bennett just wrote, he brings Coke Zero to restaurants and they don't have it. I've said this before, and so is that the reason you know that? We were at, so my wife and I were just in Australia. The first day we get there, we land, we go to our hotel. They didn't have the room ready. So we're like, okay, we're going to walk around. We're going to see some shops. We end up getting a tattoo. But we went to a restaurant, and it was called The Farmer's Daughter in Melbourne, Australia. So I walk in. What do you guys like to drink? My wife goes, I'll take water, blah, blah. I go, I'll take a Coke Zero. They're like, well, we have organic pop. And I just like looked at the waitress. I looked at my wife, and she just goes, I'm sorry, PG. She goes, do you want to leave? I said, I really do. The waitress comes back and goes, do you like Coke Zero? I'm like, I love it. She goes, we actually have Coke Zero in the back. We're just not supposed to support it. It's like, if you don't mind, I'm just going to pour it and not bring it out to you. I said, fine, I'm not bring the can out to you. I go, fine by me. It literally, I was going to leave the restaurant. Or I said to her, I actually said to my wife, I'm like, if they didn't have Coke Zero, for her saying that, I would have just gone to a local 7-Eleven or whatever the local store is and just brought it in. I always tell every restaurant, just charge me for the pop. I just need to have it. Like, it's a big thing for me. So anyways. Oh, yeah, exactly. They tried to give me a free, and then on the way back, or on a plane flight, I order Coke Zero. The flight attendant brings me pop. I drink it, and I literally go, hang on a second. The guy turns around, I go, this isn't Coke Zero. Is this Diet Coke? He goes, yes. I go, that's not Coke Zero. He's like, we ran out. Motherfucker, we did not run out. The lady, the flight attendant who liked me a lot, I guess she comes up, the new flight attendant comes to me and goes, hey, this guy came to me and said, hey, your guy doesn't like the Diet Coke. So she came and she found 2 Coke Zeros in the back. So she brought me those from the people and Coach. Sorry, people and Coach.
No, you're not.
No, I'm not sorry at all. Anyway, Southwest Airlines. So this is 3.3 billion. Is that I actually thought it was going to be higher than that.
3.3 billion. I did the math. I'm
Guys,
pretty confident it was about what it was.
Put a 15 multiple on this. It's a $97 stock.
Yeah.
Come on. And by the way, I'm not saying it's going to happen. I'm not saying, but again, we look at this. Let's go look at our stock analyzer tool. And guys, by the way, on my stock analyzer tool, I'm very conservative about this. I didn't even go to 15% on my high side.
You're below all the analyst estimates right there on
Boom.
revenue and profit.
And on my PE, best run airlines with that ROIC was double digits before, if you factor in taking out the post-COVID. And guys, $51 a share. Look at this. 60 to 180, and that's with reasonable assumptions. I do think this is a $130, $140 stock at some point. Now, here's the question. How does this all come together? I have one more stock to do, and then we're going to explain to you, because several of these stocks, Meta was the only one that didn't have, wasn't obviously green on everything. But the final stock, and this is the one that I actually like more than PayPal, is Adobe. Guys, Adobe, and it's funny, I talked to Gary yesterday. I said, Gary, if you looked at Adobe, he goes, me and everyone else. And I said, what are your thoughts? Like, too hard pile. I was like, I love Gary. And I say this to his face all the time. I go, Gary, you overthink. Your MIT brain, because he went to MIT, and if you talk to him for 14 seconds, he'll mention it 8 times. But whenever he says MIT, I go, Gary, did you go to MIT? Every single time he mentions MIT, I just interrupt him and go, Gary, did you go to MIT? And he'll say, yeah, I did. And then Mo and Mikey will laugh because they know exactly what I'm doing there. I believe, and maybe this is self-fulfilled, but I remember I started buying Adobe after it fell. Because look at the stock. Let's go look at Adobe stock. Oh my God, Nasdaq's down 1.65%. 1.65%. When am I going to have a real bear market? Not these bitch-ass bear markets.
They like to tease you.
Adobe was at $700 a share in 2021. 52-week high was $465. I'm in the negative on my Adobe shares. It's fine by me. I'm sitting there and selling cash secured puts, which I'll get into. I think AI enhances a company like Adobe. Gary's comment was, it's not as good a business as it was before. To which I always, whenever I hear people say that, I go, no, you just didn't realize it wasn't as good a business as it. The things that are happening today were going to happen. That's the reason for margin of safety. We look at Tesla, and everybody, I remember 5-6 years ago, everybody saying you cannot bet against Elon Musk. Now, Tesla is literally losing business because of Elon Musk. Because he got too political and people hated that. More power to him. Adobe's revenue is up year over year. Its profit is up year over year. Its free cash flow is up year over year. Doesn't mean there aren't headwinds. But look at this. 89% gross profit. So here's my thought on Adobe. It's purely simple. Okay, let's take the growth numbers, make them nothing. Let's take their profit margin and free cash flow margin and just cut it. Because here's one thing I love about Adobe. Look at these free cash flow numbers. $10 billion last year versus $7 billion in profit. 5-year free cash flow, $7.8 billion versus $5.5 billion in profit. People focus on the net income, not the free cash flow. So I purely go, analysts, again, this is analysts. They have a 50% increase essentially in earnings per share by 2030 and revenue growing high single digits.
Company guided for 10% in 2026.
They could be wrong.
Yeah, correct. And the issue is, though, when people say it's a worse company now, no, this was the future of the company one way or the other. Like when it was growing 16% a year, reasonable people said, yeah, at some point they're going to grow 10%. You're seeing that with a bunch of different businesses. Like
for sure.
Airbnb, Uber, like people like to perpetuate out what's currently happening to happen forever. And
correct.
Basic laws of economics say that's just not possible.
Well, it's funny. We talk about Bitcoin and guys who say like Bitcoin's going to grow 30, but when I hear Michael Saylor come out and say it's going to be $10 million coin, I go, so it's going to grow 31% a year for the next 30 years, which means it's 10 times larger than the U.S. economy at some point. It's
yeah, if it becomes worth 13 million, because we were actually talking,
13 million,
Dalton
thank you.
And I were talking about this because someone posted great insight. Don't fall over.
Yeah.
Someone posted a great insight of like, here's what it would be larger than. Like it would be larger than the entire gross domestic product of the 50 largest countries in the world. Like it would be large. It would be like 8 times larger than all of the gold in the world's value, silver in the world's value, copper, everything all combined. Like it would be worth 273 trillion was the total number if Bitcoin went to 13 million a coin.
Whenever I look at assets, and I think about things like this, and people will say, no, Adobe can grow 20% a year. I go, okay, but at some point, if it just grows. Yesterday, I was with a new guy who started with me. His name is Michael. He's running my luxury Airbnbs. We were talking about property value appreciation. I said, what are you going to assume property value appreciation? He said 3 to 3.5%. I said, listen, I think you're low. And I explained to him why. Because I think about things this way. I said, what drives property values? People say, oh, supply and demand. But no, at the end of the day, it's just income. If your income goes up tomorrow, you're probably upgrading your house. If your income doubled tomorrow, if your income fell in half tomorrow, you're probably downgrading your house. At the end of the day, I look at it going, it's very, very difficult on a nationwide basis or even a local basis that real estate values go up faster than the local incomes are going up. Okay? So I think the same thing about companies like Adobe. Or any company that's killing it, NVIDIA, it can't grow 20, 30% a year for the rest of the time Because at some point, the math dictates that if the U.S. economy is growing at 5% and this company is growing at 30%, it doesn't take as long as you might think for this company to be bigger than the U.S. economy. And does that make sense? At some point, you got to say, all right, it can't grow that big. So with Adobe, any questions on Adobe? Great question, Sam. I did 4, 7, 10% revenue growth. Guys, I'm going to do 2 analyses on Adobe here because I want to show you guys what I mean by like what's being factored in. Profit margin, free cash flow margin. I did 38, 40, and 42 on free cash flow. PE, 18, 21, and 24, because look at these returns on capital. And then 9% return. I feel like this is more of the meta play than PayPal is. Look what we got here. 270 to 400. Basically, look at free cash flow. 400 to 853. Now, I'm going to go in and beat the shit out of this thing. Ready? 0, 3, and 6% growth. I'm not going to worry about profit margin. Free cash flow. I'm just going to make it 30 across the board. And 10, 12, and 14 times free cash flow and earnings. Earnings. We're getting to the point now where it makes sense at those numbers.
Heads I win, tails I don't lose. If that's what happens with Adobe, I would say that you made a sound investment. Because the upside was significant. The downside was you still make money over the long term. If you own Adobe for the next 10 years, that occurs and you make 7.5% returns, I'd call that a success. Because if you do 30 of those, some of them are going to turn out at the 25% return. Some are going to turn out at 7.
And then a lot of them are going to turn out in the 10 to 20% range.
The middle range. Yeah. So you're going to be, I think maybe it was Chuck Akre, Peter Lynch, probably one of them said, like, on 60% of the investments, you're going to be right. And you're going to get your 10 to 15% that you.
By the way, if you get it right on 60% of your investments, you're going to crush it.
You're going to absolutely crush it.
Yeah.
But some of your investments that you make, if you make 9 investments, 3 are going to end up doing better than you expected. Some are going to end up doing exactly how you expected. Some are going to do worse. Overall, you'll crush it. In the investing game, you don't have to be right all the time.
And if AI is going to destroy Adobe, are you telling me Adobe's software and stuff like that is not really useful? At what point does OpenAI just go, yeah, we're just going to buy Adobe? At some price point. I don't know. I look at this going, guys, this is a heads I win, tails I don't lose, or I don't lose much. I look at this saying, this is crazy to me. Like, okay. And by the way, I thought it was a great deal at $350. I was like, okay, that makes sense. But if you look at my assumptions before, it made sense at $350. Let me put my other assumptions in again. What's it doing? Let's do 5, 8, 11. I'm going to do 38, 37, 39, 40, 43. Let's do 16, 19, 22, 16, 19, and 22. That way I have it saved in my, I just look at this thing going, fudge, I'm looking at 15 to 27% returns. Like, even if I'm wrong, is it going to be 5 or 7%? I mean, guys, if every investment you made, your downside was that you're going to make 5 or 7% returns over a 10-year period, you're going to do pretty well. In fact, it's a conversation we talk about the real estate business. We've only had like one property ever that we sold at a loss. Ever. We have you know what that said to me? It's not me bragging going, look how good we are. I look at going, we aren't being aggressive enough. And I look at this saying like, that's what I feel here. What would happen to Coca-Cola stock? By the way, if I stopped drinking Coke Zero, if you looked at McDonald's, I was out of the country for 3 weeks. I didn't have McDonald's except for like the new countries. Their stock fell. It's not a coincidence, guys. It's not a coincidence. Now, options chains. This is what matters, guys. We're sitting here and this is the crux of what we're trying to do here. I sold puts yesterday in Adobe. I sat there and said, guys, I want Adobe stock. I have enough right now, but if it falls further, I want to buy more shares. The reason why cash secure puts are so awesome is it's literally going to pay me to buy Adobe shares at a lower price. I repeat, I'm going to be paid to buy Adobe at a lower price. Right now, my cash sits in my account making 3.6% a year on 90-day treasuries. Let me show you this. Let's go out 1 month. March 13th, 2026. And if you have our software in a certain group, you get the options chain. The stock's currently at 250. I immediately go to the annual ROI. Guys, if I were to do this over and over again, these are the returns I'll get. So I'm going to sit there and say, I want Adobe at 15% cash return. Guys, I can sell a put at $215 per share on Adobe. It's at $253 per share right now. $253. I can sell a put for March 13th at $2.15 a share, and I'm going to be paid $2.75, which if I did that annualized, it would be 16% on my cash. But what does this mean? If Adobe falls below $2.15 a share, I get the stock at $2.15 a share. I also keep my $2.75. So essentially, I paid $212.25 for the stock. So I get the stock at $212.25. If the stock is above $2.15 a share, guess what? I keep my $2.75 and that's it. I got paid $2.75 for every share, which basically means if I did this over and over and never got the stock, I'm still making 16% on my cash versus 3.6%. Now, I threw a lot at you. The big thing you have to remember is this. I'm getting paid to buy shares of a stock that I love at a lower price. The next question should be, what's the catch? Well, the catch is if the stock goes to 100, I'm still paying $2.15 a share. So that's why I always tell people, only do this if you would buy the stock at $2.15 that very second. Because if you're not willing to do that, don't sell the puts. That's the big key. And a month isn't a long time, but you can go out even further. You can go out to September. And at the same $215 per share, call it $210, I'm being paid $15 a share. The issue is, what if something happens in the meantime where all of a sudden we find out, oops, it was fraud? Look at Sprouts Farmers Market. I lost it at $165 a share to covered calls. I got lucky, it plummeted. I sold puts at 80. All of a sudden they come out, they're being investigated and being attacked for SEC. The stock fell to 65. Guess what? I got the stock at 80. Okay, I got the stock at 80. But that's the risk you have. The story changes, the thesis changes in that time, and usually it's a fraud thing. So guys, please ask questions on this one because this is really important. But it just shows you the power. I'm sitting on tons of cash in my account. I can now make double-digit returns on my cash, buying stocks I want at lower prices. Let's go to PayPal. Go look at PayPal. Same thing. March 13th. If I want PayPal at $35 a share, I'm going to be paid 52 cents, which is an annualized 19%. I can go even lower. You want it even lower? Good. 7% return is $33 a share. Yeah, it's nothing amazing, 7%, but the key is you're being paid an extra return to buy stocks you want at lower prices. What are the questions so far? Yes, you do need enough cash on hand for the full contract, 100 share minimum. That's correct.
But Dalton will discuss poor man's covered calls.
Well, we have this cash secure puts.
Okay, we're on puts right now.
Yes. But you do need the $100. Like with stocks like PayPal and Adobe, when they hit and your gains skyrocket, what is your thought process? Oh, well, that's a different conversation. They should be renamed to PayPal.
People love PayPal. That's popular.
I've never heard of that before.
Oh, on Twitter.
Oh, is it really?
Oh, yeah.
I never heard that one.
There's a whole PayPal community.
Is it really?
Yeah.
Guys, the big thing here is understanding this concept. It's if you want to buy, this is a very, very, and here's the thing. Even if you don't have the money to buy 100 shares today, you got to understand this. And the reason being is you've got to be able, and by the way, if you can do a poor man covered call, I'm sure there's a way to do a poor man's cash secured put.
There is. You can do it both ways.
And the poor man's version is you don't have 100 shares worth of money.
Still generate income though.
But you're still generating income. You've got to understand this stuff for some point in the future. That's the big key. I tell this to everybody, like, it's not about today. It's about where you're going to be when you retire. Would you rather go into retirement going, okay, now I got to learn, or would you rather walk in going, I'm ready for this? And these things make a difference, guys. Adding a few percentage points every single year to your returns is huge. Huge. You cannot understand how big that is. Guys, if I had learned this back in my early 20s, the amount of money I would have made over the years is insane. Guys, it's absolutely crazy to sit there and say, I have cash coming in from my businesses. Now I can use that. And by the way, every single month, this is what I do. I buy an ETF and I sell cash secured puts on that same ETF for the following month. And I just do it on repeat. If I don't get the shares, I got the cash. If I do get the shares, I'm happy I made my investment. That's the mentality I want you to have. And guys, it's not just some voodoo thing. When Warren Buffett started his investment in Coca-Cola, he started one of his most popular investments. He sold cash secured puts to do that. He sold $7.5 million worth of cash secured puts. He kept that money. He sold them at $35 per share. The stock was at 39. The stock fell below 35. He kept the $7.5 million, but more importantly, he got his Coca-Cola stocks. That's the big thing. Guys, I want you guys to tell me, what level of experience anybody here have in this kind of option, cash secured puts? Let me know in the chat. Also, let me know where you're from, because I always like hearing that, like where everybody's from. That's pretty awesome to me. But tell me where you guys are in the options world. Have any of you guys ever done the cash secured puts? Nothing? Maybe it's waiting. Maybe it's on delay for us. Let me pull up the, I don't have the, where's the link for it? Is it in our community?
Click live coaching.
Is it this one?
Yeah, the Freedom Wealth.
No, I'm talking about
you're talking about the live stream?
the live
Yeah,
stream,
go
yeah.
to stocks, community chat,
Boop.
and then go to announcements.
Look at my buddy over here and knowing it. Right here.
Yeah, I better know it for how much time I spend in the community.
Oh, thanks, David. Give us some of your examples of that.
No, I'm talking about you're talking
Oh, shoot.
I
Put
don't
that
like
on
hearing
mute.
my own voice, Paul.
I hate the sound of my voice.
You too. It's not what I sound like in my head, so I'm not a fan of it. I always ask my girlfriend, like, do I actually sound like that when I talk? And she's like, yeah. And I'm like,
Everybody hates their voice. Guys, the bottom line is these cash secured puts are incredible. And I actually, oh, great. Thank you, Ramona.
stuff's starting to flood in now with questions.
Good. I can only do level 1 options, unfortunately. That's not unfortunate. It's better than nothing. I set up a separate account just for dipping my toes in options. So far, so good. Now, remember, guys, I don't talk about options the way other people talk about this, like big gains to happen. That's not my goal. I'm not here to kind of go, hey, maybe this company will skyrocket. Make it. No, I'm looking at this purely to generate income, purely to generate a few percentage points a year. This is what's important to me. Oh, shoot. How do I do this? Get out of that. There we go. Let me show you guys, like on retirement calculator, how big this is. Let's go to our history.
Paul, before you get into that,
Yeah.
give them a reason on why you started doing options. And if you were my age, say you're back in your 20s, and we can talk about that in the stock analyzer. We can start with a scenario when someone's my age when you do it. But talk about what got you into options, why you really started doing them.
You know what I love about options? It kept me busy. It kept me from not being so quick to go, I got to pull the trigger right now. I want to get myself invested. We all go through that. We all sit there and want to get our money invested. When I learned about selling puts, it allowed me to go, I'm going to make money no matter what I do on cash secured puts. On covered calls, instead of sitting there going, how do I buy more stock? It's like, no, just make the money, extra money on the stocks you currently own. That's what got me into it. When I did that, game over, guys. Absolute game over. I wish I'd done that when I was Sam's age and Dalton's age. I had the money to do it back then. I didn't even know about it. But getting that income just felt so satisfying, and it satisfied my need to go out there and do something. That was the big thing. Guys, we're always so antsy. Like, remember, Munger always says, the money's in the waiting. The money's in the patience. This is a good way to keep myself busy. I called Gary one day, Gary Mashuris. I said, Gary, that's what I want to do. He goes, yeah, it makes perfect sense. And the best part is it'll keep you busy and less likely to make force investments to happen. I was like, that's brilliant. That was the best part about it. That's so important here when it comes to these kind of things. Wow, made about 10,000 additional on covered calls. That's what I mean, guys. He made his money back several times over already, and it's only been a few months.
Oh, yeah.
That's
It's simple
incredible.
math.
The math is awesome. I love it. Every month, I look at my account, I do my report, I go, oh, cool, more options income. I love it. And I'm going to use that to live off of. And the great part is, you can live off look at the extra money. You're telling me he can't go pay his mortgage with that money? Or a big chunk of it? That's what's great. His rent, things like that, it's awesome.
You got an options is the best thing I've learned in the stock market comment.
Why is that funny? The one above it, are you talking about? Yeah, the one above it's the funny part. Seeing Bitcoin fall every day makes me very horny. Makes me very much horny. I don't blame you.
The comment that just came across about
Yeah.
options being the best thing is from Stonks in the community.
Oh,
That's
Stonks?
him. Yeah.
Listen, I love the options. And guess what? It gets risky. It doesn't get risky. There's no free lunch. There's no free lunch. That's the big key there. You've got to remember that, but on cash secured puts, the biggest issue is, does something happen in the meantime where the stock falls so precipitously that you didn't see and you wish you never bought at that price? That's the hard part. But at the end of the day, that's where your research ahead of time is going to come into play. And that's why I always tell people, don't sell puts for a year out. Sell puts for like, I like doing a month out. And I basically just go to my options chain and do that. Now, let's go here and see the difference in returns. Guys, let's say you're 30. You have 65, you're going to retire at 65. You have 100,000 in your brokerage. You're saving 12,000 per year. You're going to increase that by 4% per year. Let's say you put all ETFs, 9% return, 6% during retirement. You're going to die at 95. Inflation is 3.5%. You make 75 grand a year and you want 100% of that in retirement, inflation adjusted. Do you have enough to retire? Yes. How much do you retire with? 6.6 million, and you die with 7.4. Now, we say 2 to 4%. Let's just call it 2%. Let's say you make 3%, but you have to take taxes. Let's call it 2%. So you go to 11% returns overall, and then in retirement, you make 8%. Remember, you were retiring with 6.6 in the previous example and dying with 7.4. Look at how different this is now. You're now retiring with $10.9 million. That 6.6 becomes 10.9. And instead of dying with 7.4, it's even more egregious. You die with 68 million. Now you might sit there and say, well, Paul, I'll be dead. Who cares? But what about your family? You can leave all that money to grandkids, great-grandkids, or buy houses. That's the big key with 2% return. I only did 2% extra return. So when I hear people say like, oh, I don't even need to learn it now. Yeah, learn it now. Because it's worth millions of dollars to you. It's absolutely worth millions of dollars to you. It's not a free lunch. It does have its downsides, but everything has its downside. Nothing's a free lunch, except for maybe dollar cost averaging. But even in low cost ETFs, but even that, when the market goes sideways for a very long period of time, there's still issues. There's no such thing as a free lunch, but boy, oh boy, this is awesome.
We actually have someone in here who I spoke to on an options call recently and is signed up for the class. He just said, rubbing hands, looking forward to the upcoming options class.
Oh, that's great.
Christian is an awesome guy. He's retired, Cincinnati area. He was a VP of operations for a tire company. He's going to do great in the class.
That's awesome, like Christian. Yes, you can do options on ETFs like SCHD. I actually said that earlier because that's what I do. Every month I buy SCHD and I sell cash secured puts on them. You can do options on basically not any stock, like small, obscure ones, you can't do it. It's got to be larger cap companies, but definitely ETFs you can do options on. It's awesome. Guys, that's the power of this. 2% a year means millions of dollars. And by the way, I didn't talk about somebody who was making $500,000 a year. I didn't talk about somebody who had $1 million brokerage account. I talked about somebody with a $100,000 brokerage account who makes 75 grand a year. They just save ample money. That's the point. Now, ETFs, the options income isn't as great, but it's still extra money. It's still good. Now, they won't let you do covered calls or puts in your Roth. My Roth lets me do lets me do covered calls. I don't know about cash secured puts.
You may have to request special access or something.
Yeah, maybe.
I know that I can.
Aiden Johnson, I'm going to answer this real quick. He asked, do you have any book recommendations? Go to my Twitter. I have one saved post on there, and it's my books recommended books. If you don't follow me on Twitter, shame on you, at EMPaulG, where I'm going to be trolling people like crazy, especially as Bitcoin falls further. Okay, so let's do covered calls now. So what is a covered call, guys? Well, a covered call is, and this is the one that I think needs a lot more guidance because it's something that I have learned a lot about. Covered call is, you have a stock, let's say Adobe. It's $250 a share. You sit there and say to somebody, you go to options chain, you go to the calls, you go to February 13th, you give somebody the option to take the shares away from you at a certain price. So the stock's at 253 and you say, okay, I want to make a return of 15% of my money. You sell a covered call at $300 per share. Somebody pays you $3. It's a 15% annualized return. If you did this over and over again and never lost your shares, you would add 15% a year to your returns. Okay? Now, why is it so high? Well, Adobe's been very volatile lately. The more volatility, the higher the premium. But this is a month out and the share price of 300. So here's the risk. In a company like Adobe that's so undervalued, the price can skyrocket very quickly. But when you have stocks that are like more fairly valued, especially let's pick a company let's say you have NVIDIA and you're like, listen, this thing is massively overpriced. I don't care if I lose it. You go to the options chain, you sit there and go, March 13th, the stock's currently at 189. I'm okay if I sell a 200 call on this. You're going to get a 39% return on your money if you annualize, do it over and over again for a year. It says, hey, if it goes over 200, you give the shares away for 200, you still get all the gains between 189 and 200, and you keep your premium. So essentially, it's still like selling it for $206, $205.89. But it's basically a way that you give somebody the ability to take the shares away from you at a higher price. Now, what's the risk there? Well, on a low-valued company like Adobe, the stock skyrockets suddenly because everybody sees the value, and you lose the shares on a fast-growing business that's massively undervalued. That's why I always tell people on covered calls, don't be very careful about that with massively undervalued. In fact, Dalton and I have decided, based on how undervalued the company is, at a certain point, we won't even sell covered calls on it. Like something like Adobe, something like Southwest. We're not going to sell covered calls. I'm like, listen, I want that upside. You know what I mean? But if it's a company that's more mature and selling for a good price and you're okay, sell covered calls. Something like, what's a reasonably priced company right now?
I'll give you an example. So we talked about it before, but Bank of America I was buying in 22, 23 when it was down to like 25, 26 bucks a share.
Yeah.
That's a business that's going to grow what? 1, 2, 3% a year.
Not a lot, yeah.
It rose up to $50+ a share. I used covered calls on that to
Did you?
sell my position. Yeah. I had like 120 shares. So I used that on the main 100 and then just exited on the other 20.
So it's funny. I did that on Southwest the first time around when I bought Southwest at 25 and it skyrocketed to 50. I sold covered calls to get out of the position, and then it fell and got lucky. But let's look at Meta, because Meta wasn't selling for like that much of a discount.
Yeah. Meta is one that, I think that's a good example of one.
Or Google. No, this is a good one.
No,
Google.
Google's definitely a good one.
That's a good one. Alphabet.
That's something a lot of people in the community, I mean, we have hundreds of community members who have loved Google sub 150 for a while, and now they're up
yes.
this much. And the question is, what do we do?
Yeah, because if you look at the stock analyzer, it's probably selling for, let's see what I did last time on stock analyzer. My assumptions. It's worth 300 according to my assumptions. So it's perfect idea going, listen, it's probably, I don't necessarily like, I'm not going to be upset if I lose it, but I look at this going, okay, it's at 313 and I want to make a reasonable amount of money. Let's say I want to make extra 8%. Guys, it's got to go to 345 in the next month. So from 313 to 345, I make all the profit. I still get to it. So I basically make all the profit from 313 to 347. And then from there, I lose the shares. Okay, I made an extra 10% of my money today in a month. Again, that's key because I look at Google going, it's probably, I mean, maybe it's not worth 347 to me, so I'm okay losing it. But I wouldn't do it on a company like, for me, my opinion, Southwest that is selling for 50, but I think it's worth 100 because there's too much upside there. I don't want to lose it at $60 and then lose that upside. You will get an option chain on your version of the software if you join our chat. You still get the dividend on your covered calls. However, you have to be careful. And these are the things we're going to teach in the community. Avoiding dividend dates, because people might take the shares away from you, and avoiding earnings results, because I don't want the volatility. Like, I don't sell covered calls around earnings, because what if they crush it and it skyrockets? I want that upside. So there's other things that we do in there that you're going to learn that we haven't even touched on in our class. We've already done one class. It was massively successful. I want to say like 2/3 of the class made their money back very soon. There's no guarantee, but Sam, why don't you tell people about the class?
Yeah, guys. So I've had conversations with a lot of people already since the last options live stream that we did. So the Freedom Wealth Project is this class that we're doing. It's going to be 8 total sessions over the course of a month or half or so. This is one of the only times you're going to get to actually speak with Dalton, speak with Paul. We limit the class size, so there's not very many seats still left. They're extremely limited. Like I said, I've talked to people, so we've filled most of the seats at this point. You are going to get to actually be coached through all of this. You can stop them. You can ask questions. You can actually get to know Paul on a more personal level. I've sat in on classes in the past. These people actually get to interact with Paul and Dalton regularly. It's no different than if you're going to pay for a college course, you're going to pay more than $5,000 to learn something that doesn't have a direct ROI. This does. You can do the math. You can figure out with your portfolio how much money you'll instantly start making today. Like Paul said, in the past class, people, I think 60% plus made their money back while the class was actually still ongoing. And after a few months, it's up to 100%. So there's a lot that comes with this. Number one, you get a full year of our Oracles of EM tier, which is worth around $1,000. I have a ton of people who regularly sign up for that. That's when you get Stock Analyzer, 8 Pillars, the community chat, the live streams that we do, trading sessions with Mo and Bailey. You get the options chain, options return calculator. It's an abundance of tools, an abundance of courses. You get special chats dedicated to this class so that in between classes, Paul, Dalton, myself, we can answer your questions. We can send you anything we think would be helpful for you to read. We want to make sure that when you do this course, when you go through these 8 weeks, you go from a beginner and new in options to a thorough, strong understanding, and you are actually practicing it, and you will have a benefit over your entire lifetime. A benefit that you can teach to your kids, you can teach to your family members. You should be able to, after you go through this class, to deploy this, make your money back, and then continue to benefit for the rest of your life. It's an incredible opportunity. If you guys are interested and you actually know for a fact that you want to do it because it's going to be an extreme value and there's limited seats left, you can go sign up today. There will be a link to use. If you have more questions about it, I'm available to have 30-minute calls with you guys. I'll get to know you. We can actually talk about your real scenario. We'll talk about, where you're at in your life, how much money you have. I'll be honest with you. We'll talk about whether or not it's a good decision to do this class. Go sign up for one of those calls. At the very least, it's worth sitting down to talk with me because this could be a life-changing opportunity. It's an investment in yourself.
Yeah, and question over here, will there be recommended trades we can follow? I don't like using the word trades. I don't look at this as trading. I look at this as a tool to supplement your investing. Remember, we can't just tell you, go do this, go do that. What we're going to do is say, hey, based on your portfolio and your goals, what do you think about this? Here's what we do. At the end of the day, we're here to teach you how to fish. That's the biggest thing. You guys have seen that from all of our videos. Remember that my life goals and my decisions I make for my money are totally different than everybody else. Why? Because my finances are totally different. I don't mean better, worse, anything like that. What I mean is I'm different than a lot of people. So the decisions that I'm going to make on my money are different than yours. The reasons you own a stock are different than mine. We might own the same stock and we have different values on them. So you're going to sell a different covered call than I will. You'll sell a different cash secured put than I will. It's about understanding what that tool is. This is not trading. This is sitting there and saying, I'm using this tool to make my investing decisions better. That's a big part of it. And by the way, we have a lot of people who've had calls with Sam about this one. This is not going to be a big group. The big thing for us is we want to be very hands-on with this. This is not going to be a big group of people. This is going to be a very hands-on group. We're going to be working with you guys to sit there and teach this process. Because it's not just about, it's like, I joked about this one time. I remember thinking to myself, like, I'm a tennis player. Roger Federer could come here today and tell me, Paul, here's how you hit a serve. But at the end of the day, I've got to work on that over and over again and with him to sit there before I'm able to play even like him or something like that. I know that's extreme because Roger Federer is the best tennis player of all time, but even call it somebody who's slightly better than me. I'm not going to be as good as them just because they explain something to me. But if I'm able to work with them over and over and have access to that for a very long time, I will get better. That's the whole idea here. That's all we're trying to do here. That's great. I'm really glad to hear that. I don't know how to pronounce your name. I understand you use the hard part of the time necessary to research. Great. But that's the thing. That's why it's a good idea to be in this whole community, because you will get your classmates and other community members with you forever. And you guys can have conversations about different cash secured puts and covered calls that you're doing. Listen, not going to lie to you guys. All the people I talked about covered calls and cash secured puts think I'm way too conservative. But I like being that way. Other people think, oh my God, Paul, I can make so much more money than I don't want to. I don't need to, because my goals in life are different. I can live off of a 2% extra return on my money all day long. So for me, that's different. I just don't want to overpromise and underdeliver. I want to sit there and say, listen, it's funny, Gary, who's like the most conservative guy in the world, said to me, he goes, so what do you expect to make on these things? I go, I don't know, like 1% to 3%. He goes, oh yeah. He's like, you'll do that. Like that was his response, and he's a conservative guy. And I said 1% to 3% just to, for me, if it's 1% a year for me, I'm happy. Now, have I been able to do better? Yes. Every single year I've done better than I've never done. But again, it's all based on what your goals are. That is the big thing. That is the thing that everybody doesn't understand. No, sorry, not that everybody doesn't understand. Everybody wants a one-size-fits-all in money. There's no one-size-fits-all in money. And you know what's funny, Sam, about that? You talk about Morgan Housel. I love how he talks about that. You know, this new book, The Art of Spending Money, and then The Psychology of Money, the biggest thing about it was realizing that every personal financial decision is exactly that. It's more personal than financial. And hey, that's his quote, and I love that quote.
Yep, absolutely.
And I look at that going, that's the same with investing. The reason why you might sell Adobe at 500 is not the same. It's a very different reason than when I would keep Adobe till 600. In personal finance is more personal than finance. What we're here to do is teach you these tools, like dollar cost averaging. I'm here to teach you about dollar cost averaging in the community and the videos. But what you dollar cost average into is completely up to you. You might be QQQ. It's funny. I told Dalton something once recently. I said, "Hey, Dalton, what do you think I should do?" He goes, "Paul, SCHD." And it's funny because I make fun of all the SCHD bros out there on Twitter. But he was like, dividends. "Paul, it fits your lifestyle. You don't need to make 15% a year. You need to make 4% a year. So just get SCHD. You'll get 4 to 6% capital growth, and you'll make 3 to 4% dividend." I go, "Great, that's what I'll do," with a lot less volatility. That worked for me. But it doesn't really work for you. If you're in early growth mode and you get, that's not going to work for you. But we're here to sit there and teach the fundamentals that do make sense for all the things you're trying to do. Yes, superconductor, you're exactly right. Yeah, that's great, Jim. That's exactly the idea.
And on Jim's point, if you're in a position right now where you say you don't have the financial base, maybe you're not willing to spend $5,000, there's no reason you should not be a community member, though.
Oh, 100%.
For significantly less money, you should be part of the community. We talk about options. One of the biggest things that I say since I've joined the community, I've obviously been following Everything Money for over 5 years, but the biggest difference is time saved in generating great ideas.
Yeah.
The conversation that goes on in there, number one, it's a backboard for when you do have a great idea. All of a sudden, you have a group of 15, 20 like-minded investors who you chat with regularly to go say, "Hey, what does your stock analyzer look on this company? I'm thinking about selling options at this price." I did it just the other day. I was looking at a company, potentially selling options on it, and I went in and talked to a guy in the community who's incredible with charts. He's also a good value investor. He uses options very well. And I said to him, "What do you think of options at this price?" And he came back to me and said, "I like that from a value and options perspective. From a charts perspective, though, I'd go a little bit lower if you're just trying to generate the income." He said, "I'll go a little bit lower because there's a support level there that if you go $1 lower per share, the odds that you're going to get it go significantly down."
And that's one of the things I need to add in mind is talking about charts in it. Because saying like, listen, I believe in momentum and things like that. And guys, again, I can't repeat this on blue in the face. It's not to sit there and there's no such thing as a free lunch. But what it is if you go in with a process that you can repeat and understand the downsides and the upsides, doesn't matter what happens. Just like when I first realized like what value investing was, it made so much sense to me because I was like, oh, the calm of seeing a stock fall was what was a game changer for me, right? That's the big thing. When you're sitting there going, imagine if you can sell a company someday and make a few extra bucks while you sell it. That's cash secure. That's covered calls. You're getting paid just a little bit extra. It's like a commission on top. Like your broker would charge a commission in the back. Now you're giving yourself a little extra money to sell a company. These are the things that we talk about, and this is what matters. There's no such thing as a free lunch, but what there is a process that can help make your life financially better, no matter what your goals are. And understanding those goals is something we're going to get very intimately involved with. And guys, I'm going to tell you, this community is getting bigger and bigger. At some point, the ability to get into a small group of 5 or 10 people who can talk about the same topic directly with me, Sam, and Dalton is going to be harder and harder. So make sure you jump on that. Get on a call with Sam. If you're not ready to make the decision today, but if you are, I love it. Guys, any quick questions before we go on these things? Guys, again, it's going to start soon. Seats are almost gone. We're not going to have a big group here. The first group was larger. I think it was like 17 or 18 people. And we realized, okay, that's why we need to get a smaller group. We wanted to be able to answer way more questions.
I already just got to sign up for an options call.
Perfect. Love it. Lululemon's getting, I don't even see Lululemon. Let me see that lately.
I know it got a little bit of a bounce up to 200. Oh, it's right back down. All right. I saw it bounce from 200.
It did go to 200. I remember that. Look at that. Lululemon. All right, guys. Well, thanks very much for your time. I think this is wonderful. Thanks for learning. We're going to be doing a lot more webinars and live streams to sit there and teach processes for things. Stick with us, guys. I mean, we've never had a declining, but we've been growing every single month since we started. It's been awesome for the people who've been with us since the very beginning. Like, it's absolutely funny that I remember the first time we had a live stream, we were like hoping to get 100. We were hoping to get 100 people on, right? And I remember I was high fiving. We got 100 people on. Now, like if I did a live stream with 100 people on, I'd be like, "What the hell just happened?" You know what I mean? We've had live streams with 2,000 or 3,000 people when the market's completely crazy. Also on the main channel, but this one is a great channel. We love this Plus channel. We're gonna be around even more. Again, sign up with Sam if you want to have a call with them because he will be able to talk to you completely. He's a very smart dude. Thank you for your time, guys.